Hey Jeff, thanks for joining me.
Hey Steve, thanks for having me.
Good to have you. We're talking right now about article in Barron's titled "Downtown and Commercial Real Estate Valuations is Boosting the Appeal of Property Debt." Articles focusing on how terms and conditions are getting better for those lending money to real estate projects. Point out here higher coupons, stronger loan structures. Those are improving terms for lenders. Also, a drop in property valuations is also further improving conditions for lenders. If we look at this article, they're talking about how the dynamics aren't necessarily as good for some equity investors, but there's definitely been pluses in terms of debt. And a quote in the article, including about how previously commercial real estate debt offered returns in the neighborhood of 6 to 8%, but the current environment may lead to returns approaching 11% over the next 3 to 5 years. That was from Bernstein Private Wealth Management making that prediction. You're very familiar with both equity and debt structuring the current environment. So wanted to get some of your reaction to this article about conditions improving in terms of doing debt in real estate deals.
Yeah, I mean, I think generally this article isn't really talking about your main street lenders, your banks. This is probably talking more private debt.
Yeah.
I think as interest rates rise, the cost of capital goes up, not just for banks. The idea of private debt becomes a little bit more attractive, especially for borrowers. But from a lender perspective, traditionally, I can tell you, even as a former private lender myself, who still provides some financing opportunities for individuals. Uh, you know, 6 to 8% seems kind of low. Some of my investors were already receiving 10 to 12%. I think as the interest rates go up, you're going to see just an automatic increase in the private lenders rates they're charging, probably more closely aligned with almost usury, but not usury, just because they can push the envelope and get more. Because as Main Street rates go up, they're going to go up just because it's a little easier to get debt.
And your
You know,
thoughts just on the comment about stronger loan structures. Are you kind of seeing that maybe more preferent, not just in terms of the yield, but and the
yeah, I
return,
mean,
but more?
I don't,
Mhm.
the yield I mean, seems kind of obvious, but I think, in a lot of ways, the actual structure of the debt itself, even on Main Street, is changing. Lower leverage, which is kind of traditional in private. Most private lenders aren't pushing I mean, other than the ones that are out there advertising, who are trying to push 85% loan to value, loan to cost, which, as you get into the rates and as you get into everything else, it generally doesn't happen. But, it's not unreasonable to see private lenders go from 65% down to 50% or 45% just to protect themselves from devaluation of real estate.
Right. Okay. Really good insights. Appreciate it, Jeff.
Thanks.